We had pumps and dumps, we had fraud cases. So the initial idea of the European Commission to have the markets in crypto assets regulation started already with 2018 when the ICOs were really hyped. If you look inside MiCA 1.0, not everything is covered, like crypto lending, crypto deposits. MiCA 2.0 is not the right way forward. The threat which I see is that if Genius Act is going to be as successful as everyone is believing, the US dollar will become even more strong. I see a big risk that we were going to have a over-regulation in Europe and a killing of the market.
What should a rules-based financial system look like in the age of crypto? That question is now front and center as Europe begins shaping its second wave of regulation for digital assets. MiCA 1 laid the groundwork. MiCA 2.0 will decide who gets to build the future and on what terms. Our guest today is Alireza Siadat, partner at Deloitte Legal Germany, and the key voice on crypto regulation in the EU. As a board member of Bundesblock and a leading legal architect in the DACH region, Alireza has been at the heart of Europe's evolving regulatory frameworks for blockchain and digital assets. Alireza, welcome to the show.
Hi, Nasib. Thank you for having me today on your show and your podcast. Yeah, it's a very nice topic, which I'm actually working on it for some years. And I'm happy to look into that with you together.
Thank you for joining. So I always begin with the guest's background, right? What initially pulled you into the crypto space, and what has kept you committed to it from a legal and regulatory perspective?
So the answer to this question is both-sided. On one side, when I joined PwC at that time, PwC Legal, it was in 2014, we did a project with the European Commission, which was called Banking Without Banks. And this project then suddenly was called Fintechs. And in that project, I was told to look for a product which could be seen as banking, but without banks. So I was doing some research like for 1 week. And I came back to the group and I said, look, I have something. I'm not sure if it's digital gold or if it's like payment, but it's called Bitcoin. And I think this thing is very interesting and this is going to be the future. So this was on the one side. And the other thing, which was, I think, as exciting as what I just told you, I was watching a TV show at that time, which was called The Good Wife. And in The Good Wife, there was this one episode when a gentleman in the US was captured with the US Treasury, with OFAC, for introducing Bitcoin. So it was supposed to be Satoshi Nakamoto, or his alias. And this gentleman was put into prison and was then released by the lawyer, the good wife. And at the end of this episode, he's then like cashing out his Bitcoin, putting it on a check, and then giving this check to the lady and saying, you know, this check you have to take and then turn into cash again and put it in your account, like so many intermediaries. And she then said, yeah, I actually got some Bitcoin and let's see what it is. And he said, it's going to be the future. You're going to see. And this TV show was before 2014 even. And so this actually also like raised my interest in it, because I was thinking at that time, is it really a TV show? Is it true? And I was doing some research. I was then working with PwC on it. And yeah, and ever since I like get into the rabbit hole, as you can call it.
You've worked with both private firms and public institutions, right? So where do you feel change actually originates in policy circles or in the market?
Yeah, that's a very good question, Nasib. So I'm doing that since 2014, as I just said. And you can really see through the history of crypto regulation that a lot has changed. I remember back in 2016, 2017, when my dear friend, Professor Philipp Sandner, who has passed away, and myself did the very first roundtable for C-levels in Frankfurt, for C-level banks. And at that time, they did not really take us serious. They were like listening to us, but they were really laughing, and they did not really understand the difference between Bitcoin and blockchain. For them, it was the same. And it was the same with the policymakers and with the authorities. Because to be honest, at that time we only had Bitcoin, and Bitcoin at that time did not have the strongest position within the financial and capital market. And then I would say from 2016, 2017, and then 2018 maybe, this was the wave of the ICOs. And then when this wave of the ICOs came, the market quickly realized that there's more than Bitcoin, there are other coins. And the European regulator realized after this ICO bubble, the first ICO bubble bursted, that many consumers got hit. We had pumps and dumps, we had fraud cases, we had coins which didn't really see the light, they were only in planning, and people invested lots of money in it. So the initial idea of the European Commission to have the markets and crypto assets regulation started already with 2018 when the ICOs were really hyped. And of course then with the project of Facebook, Libra/Diem, this was the point where the European Commission said we have to be fast. We cannot really take this blockchain and cryptocurrencies not that serious. We need to be fast. We need regulation to have, at least in Europe, a harmonized understanding of how it works, and also to give to the market players, to the banks, to the big institution, the legal framework to do the business in a proper manner. And I would say this was like really the change. The first change came in 2018, then 2020, and then I would say 2024. And it somehow goes like with the Bitcoin halving, if you look at the comparison. And and that's actually how it is now. Now we have really strong demand within the traditional banking capital market. You see it with ETFs in the US. You see the different laws. We have not just MiCA, also the Genius Act or Transparency Act in the US. In the UK, we see regulations getting set up for crypto assets. And I would say now crypto is not just a niche topic for some IT nerds or some small startups. It really, I think, hit the center of the capital and the banking market.
How do you see the DACH region's approach to crypto regulation compared to the rest of the EU?
That's a good point. I mean, when we talk about the DACH region, I want to expand it to the so-called DACHLi region, because Liechtenstein is, I think, a very important jurisdiction when we talk about crypto regulation and crypto adoption. Because Liechtenstein, for those who don't know it, a very small jurisdiction within the European Economic Area. Many mix it up with Switzerland, even though it's not really Switzerland. It is a jurisdiction within the European Economic Area. And Liechtenstein was the first jurisdiction which has its own law on token, the so-called token container model law. And some say that the German regulation and also the European regulation was taking the Liechtenstein regulation as a blue pause. It could be, but to be honest, the Liechtenstein regulation is more civil law, more the civil law architecture of token regulation, whilst MiCA is the regulation of crypto assets harmonized from a regulatory perspective. And in Germany, we also had, before that, already crypto regulated. So Germany was also a jurisdiction where we had already in December 2013 from the German regulator BaFin a publication warning the investors not to invest in Bitcoin. And the German regulator was saying from December already that Bitcoin is a regulated financial instrument, whilst many other jurisdictions, not just in the DACH region, but also beyond, did not see utility token or cryptocurrencies being regulated until MiCA was there. So in 2020, and if you look at the FATF recommendations and also in the Anti-Money Laundering Directive 4, which recommended to have the obligated parties, so those who take care of KYC and the combating of the finance of terrorism, to also have a close look on cryptocurrencies. This was like the first step outside of Germany, but Germany was already ahead. Germany already said, no, it's not just an AML obligated topic. It is also essential that those who do provide custody or run a crypto exchange have a license. This is also the reason why, while we have in Germany since 2020 already the crypto regulation, and in the other jurisdictions, we just had it from middle of 2024. So Germany was already 4 years ahead. And this is also why the first major crypto exchange, Coinbase, got its license for custody and crypto exchange services in Germany. And this was, I would say, the kickoff of the regulated cryptocurrency activities in Europe and now mostly in the DACH region.
Let's talk about MiCA. MiCA 1 laid the foundation, but many see MiCA 2.0 as the inflection point, as the real inflection point. What do you expect to change most significantly?
Yes, that's also a very good point. So if you talk about MiCA 2.0, you have to understand why we have MiCA 1.0. As I just said, one reason was the ICOs, one topic was consumer protection, market integrity, market abuse, all this pump and dumps, all these things which we had with the ICOs. This should be regulated under MiCA. But also when Facebook initiated its project with Libra and Diem, we realized that e-money token and asset reference token are two stablecoin instruments which could heavily affect the money market in Europe. And this is why the European Commission had to very quickly propose a regulatory framework which is accepted by the ESMA, by the European Securities Market Authority, and also by the European Banking Authority, and by EIOPA, the European Insurance Authority. So all these four authorities had to agree to accept MiCA as a regulation for crypto assets. And if you talk to Peter Kerstens or you talk to Joachim Schwerin, both from the European Commission, they will tell you it was so difficult to get MiCA 1.0, it will be impossible to get in a short future MiCA 2.0, because then again, you have to get all the participants agree to it. However, your question is very valid, because if you look inside MiCA 1.0, not everything is covered. So we have some activities like crypto lending or crypto deposits. These are not covered by the MiCA. So you can easily do you can easily give your Bitcoin and get a credit for that, or you can give you like a credit in money, or you can give your Bitcoin and get a credit in stablecoins, and this is not regulated. So this is something which is probably needs to be covered by MiCA 2.0. And also the elephant in the room, which is decentralized finance, DeFi, it's also not covered by MiCA 1.0. And the European Commission clearly said they do not want national competent authorities regulating a fully decentralized financial system like DeFi. And that's why some say we need to have MiCA 2.0 to have a harmonized European approach to cover DeFi and other activities. Also with staking, it's not really clear. And there are some more like liquid farming and like the traditional stuff, which you usually do also in a DeFi environment, but which nowadays also centralized players are providing. So these are things which I believe will lead to MiCA 2.0. The question is when it comes. This is not clear.
You mentioned DeFi, right? And that was a really, really good point. So should MiCA 2.0 go deeper into DeFi? And if so we have kind of established that, but if so, how do you regulate something that's meant to be decentralized, right?
Yeah, so that's a very good point. I mean, regulation in general, not just for crypto, regulation in general is always looking at the service provider. So we always regulated the service provider. So the service provider could be someone who's providing custody or who's providing brokerage activity. But if you look at the DeFi environment, in the DeFi environment, there is no custodian. So a proper DeFi like 1inch or Uniswap or others, they ask the token holder to use a self-hosted wallet. So we have no custody service. And then we can just wonder, do we have a brokerage activity? And then we really must look at it. Is it fully decentralized? So we hear automated market makers. We hear like Pathfinder protocols. We hear like liquidity protocols. But is it really that it's a protocol where no company, no person has control or influence on it? If the answer is yes, no person has influence on the protocol, and the orders, like if we both would trade on a DeFi platform, you and me, Nasib, and the protocol would bring us together. So I give an order and you call it, or you buy it, yeah, you swap with me. Then this should not be regulated. This doesn't make sense. Yeah? The only thing which a DeFi protocol would, I think, like to do by itself on a voluntary basis is to comply with AML, sanctions law, and the combating of the finance of terrorism. Because what we have seen in the past with Tornado Cash and with others is that even if you put up a protocol and something goes wrong because North Korean Lazarus group or someone else is using your DeFi platform, then it doesn't really help to say we don't have regulation, because if the authorities like OFAC or US Treasury wants to get the platform down, they get it down. And this is, I think, something which I see, which I can witness in the DeFi environment. The DeFi environment does not want to do everything fully non-regulated. They understand that KYC and AML and CFT and sanctions law is important. Also protection against scammers and pump and dump and market integrity. I think these are elements which are important to the DeFi industry. So coming back to your question, Nasib, I think that at MiCA 2.0, similar to MiCA 1.0 for DeFi, is not the right way forward, because it's too much. We can see it already with stablecoin regulation, which some say it's too much, and with DeFi it would be also too much. I think a sandbox approach, as we have it with the DLT pilot regime, this could be a very good idea also for DeFi. So to have something which covers some aspects of MiCA, but is not a mandatory requirement for all MiCA players, but rather, as we have it for the DLT pilot, to have a sandbox model so the DeFi players can choose to say, we want to try it, we want to apply for this license and see how it works. And if it works, it's good. If not, no one is like pushing us to stop the platform and to stop the business. Yeah.
Let's stop for a minute. Here is a brief moment of context for those who may not know me. My name is Nasib Fathi. I'm a scientific researcher in the blockchain space, and I work with executives and organizations as a growth and media professional. My focus is crypto at the intersection of institutional finance, market structure, and regulation. You are watching the NFK podcast, where these topics are discussed through conversations with people shaping the development of digital assets space. MiCA places stablecoins under tight regulatory scrutiny, and major players like Winklevoss-backed cypherpunk technologies accumulating large positions in Zcash, for example. How should regulators distinguish between centralized issuers and decentralized financial mechanisms, whether it's privacy coins or algorithmic stablecoins?
Yeah, that's a very good point. It is not that easy. I mean, as you just said, it really depends on each case. But what I can tell you is, if someone is doing something for the blockchain, let's be it an issue of a stablecoin, let's be it someone else, and this person is not getting a financial interest, so you're not getting a fee, you're not getting paid for it, you just do it. Something like this should never be regulated. Like an open source idea to do something and you do it and you're not getting paid for it. And then by definition, it cannot be a service. As I said to you before, the regulation, not just for crypto, is always regulating services. A service must be something you do, plus you have a financial interest. You're getting paid for it. So if we have this, and we see it with cypherpunks and some others who have this idea of having open source and sharing functionalities and knowledge to the public for free, this should never be regulated.
Some critics say MiCA 1 created clarity but not competitiveness. Can MiCA 2.0 strike a better balance?
That's a good point. I mean, what we see now, I said to you before that we have in UK already a stablecoin regulation. We have in the US the Genius Act. And for instance, if you issue your stablecoin nowadays in UK or in the US, you can pay rewards or interest to the token holders. So yield. You can give yield to the token holders. You can also give yield or work with the stablecoins and give some profit or some rewards to the market infrastructure participants like market makers, liquidity providers. And this is why stablecoins like Tether, USDT, they're much more successful and they will stay much more successful than any other regulated stablecoin inside the European Economic Area, because they are in a position to work with the funds which they received to issue the stablecoin So they have an advantage. They have the commercial advantage. And if the Genius Act continues to be like it is now, and we're not getting the Transparency Act, and we heard it that Coinbase and others are against the limitation of yield-bearing stablecoins, then we're gonna have a disadvantage with MiCA, definitely. So with stablecoins, we definitely have a disadvantage. Now already, there's no asset reference token issuer. So as I told you before, MiCA covers e-money token issuer and asset reference token issuer. There's no single asset reference token issuer in Europe. We only had Ethena, who applied in Germany, where the German regulator BaFin declined the application. But if you look at Ethena is, I think, the 5 or 6 biggest stablecoin issuer, and it grew so fast. So, and now they don't do it in Europe. They didn't get the license, but they're still active in the US. They're still active outside of Europe. And I would say this is something which really clearly shows that MiCA is putting for stablecoins at least, or stablecoin issuers, compared to non-European stablecoin issuers, a disadvantage.
The proposed rules around algorithmic stablecoins are like to become a flashpoint, right? So what's your take on how the EU should handle them?
So algorithmic stablecoins, we all know it because of Terra and Luna and what happened there. The risk of algorithmic stablecoins, I think the biggest risk is that it's complicated, that people don't understand it. And so I think that the European Commission and also other players within the European regulatory environment should not hardly push against algorithmic stablecoins only because they don't understand it. I think we need some knowledge sharing. I think a dialogue must be initiated by the market participants, and I think the European Commission is very open for that. The European Commission does not have capacities to initiate something like this, but they are very happy to participate. If, let's say, an association or a group of algorithmic stablecoin issuers would like to have a workshop, kind of an event together with the European Commission, and then we can talk about it. We can talk about what are algorithmic stablecoins, what is the difference, what is the benefit, how can you make it from a commercial perspective that it's not as risky as Terra and Luna was in the back. Yeah. So I think this is very important that we need more education, not just for algorithmic stablecoins, for any complicated crypto product. We need more education, more knowledge sharing.
Will we see a harmonized EU passport for crypto services anytime soon, or will national regulators continue to dominate implementation?
I think we will see it soon. So the MiCA grandfathering period is ending by June this year. So grandfathering period, for those who don't know it, all the national competent authorities and all the market players, all the member states within the European Economic Area, they have time until June this year to fully apply the MiCA rules. So this means the NCAs, we have some NCAs like in Poland, they still did not accept the implementation law for MiCA. We have some jurisdictions, especially in East Europe, but also Italy, who still don't have the first CASP being regulated. So until we have this kind of, let's call it segregated way of regulating or acting according to the rules by each member state, then you cannot speak about harmonized environment. But I think that once we have the grandfathering period ended, which is middle of this year, I would say give it then 6 more months. So I would say by the end of this year, beginning of next year, we will really go in the direction of harmonized environment for spot trading, like for cryptocurrencies according to MiCA, for future trading, like perpetuals and other future instruments or within a crypto environment. This is still a tricky one. This will still fall under MiFID, and MiFID is only a directive compared to MiCA, which is a regulation. So regulation is automatically applying to all member states and should be applied in the same way, whilst a directive must be implemented by national law and could be applied differently. And we see this already with MiFID. So the future crypto instruments, all the future crypto instruments, are traditional perpetuals, perps, and also other future instruments, they fall under MiFID, and that's why for this bucket of crypto activities, I don't see harmonization for the next 5 years. So this is something which will most likely continue existing next to the spot trading. But future and spot trading, they go more and more together, because if you look at the market, the traditional buy and hold trader is getting less and less. Yeah. So more and more try to really actively trade. And if you want to do active trading, you automatically go into future trading, leverage trading, and other kind of trading. And that's why it's going to be interesting to see how the crypto market is developing from 2027.
What role should rating agencies or auditors play under MiCA 2.0? Should they be regulated as well?
That's a very good point. So the problem with traditional rating agencies, like Fitch and all the others, they did already some ratings in the past. So they did some ratings in the past. They rated Ethena, they rated others, and the rating was terrible. To be honest, the rating was terrible. And I think that only having like a major rating agency to rate something does not give you any comfort. Lehman Brothers was rated 2 or 3 weeks before they collapsed with A+, and you saw what happened. So crypto is more complicated. In my opinion, crypto is more complicated than traditional derivatives. So just to take the traditional rating agencies and tell them to rate crypto without auditing them, without really looking if they're doing it properly, this is not going to work. This is rubbish. So if you want to do some audit of crypto, you must do much more than just looking at economics. You must look at the IT, the cybersecurity aspects. We already have very good crypto audit firms like Hacken and others. And I see strong hope in this kind of audit companies. And do they need to be regulated? Not really. I think the market will at some point select the good ones from the bad ones, because we have some really good audit companies when it comes to blockchain and crypto, and those will do a good job. We don't need like a license for them.
There's been a push to require white papers and disclosures from DeFi protocols. How practical is that?
So if we look at white papers which we have nowadays, like the ones for utility token, for stablecoins like e-money token, asset defense token, as I would say a white paper which has really a standard format where how many pages, how the language is, how the summary is, how the content is. This is very important, because one terrible mistake we did during the ICO time is to look at this fancy white papers which were mostly drafted by marketing agencies, which illustrated to you, this famous picture where you see like in the front a nice zebra and in the back then some donkeys coming out. So this is like the traditional original white paper. It promises you the best blockchain solution, and what comes out in the end is terrible. Therefore, I would say a standardized white paper for the DeFi industry would be very good, because they already have lots of material. When I say they, I mean the foundations, the labs. They already have open source documentation. The problem is only it's very hard to find it for those who are not familiar with the different web pages of labs and foundations. And then the quality is also different. You have from 1inch or from Uniswap lots of material, and from some other DeFi actors you only find little or not up-to-date material. So therefore I'm saying a standard which really gives like a best practice, let's say it, a best practice for DeFi white papers, this would be very helpful.
How should regulators define when something becomes significant in the context of protocol trivial, user base, or risk to financial stability?
Yeah, I think we must do it the same as we do it with the traditional financial and banking market. If you look at the traditional financial and banking market, it's actually the economics. So how many assets do you have on your balance sheet? How many assets under custody? How many assets under management? So for the crypto, it would be the TVL. Yeah, and so if we put a threshold there, which we would say, okay, this is the threshold which we believe is the right one. And then we would probably need to look like at TVL, and we would also need to look at assets under custody. So both factors putting together, and then looking and saying, okay, does it meet the threshold? And that would be the right way to do it. Any other thing which could be like saying, okay, we look at some risks which are not clear, which are maybe subjective, are not good for putting a threshold and KPIs. The KPI should be very objective and transparent and clear.
Smart contracts are subject to regulatory constraints. Who becomes responsible? The deployer, the operator, or the code itself?
It's a good one. So if you look at smart contracts, if you, for example, have a smart contract which is for bridging service, or you have a smart contract for wrapping service, or you have a smart contract for transfer service, then already now you have to look if it's under MiCA, a so-called crypto transfer service. And if you look at the MiCA crypto transfer service definition and at the recital for the crypto transfer service, you see straight that MiCA says for crypto transfer service, we should not regulate those players who are important for the transaction to technically happen, which are the nodes, which are the miners, which are the validators, and anyone who's doing a similar task. Therefore, I would say we must regulate the developer of the smart contract. And in most cases, the developer of a smart contract has also access to the private key of the smart contract. And this is a person who I would say we must regulate. If we have it like in a Bitcoin blockchain and there is no person who has access to the protocol private key, then there is no regulation needed. But if there's a person who has the access to the private key to a smart contract, then this becomes interesting.
Could MiCA 2.0 unintentionally fragment liquidity across regions by creating too many compliance bottlenecks?
It could. It definitely could. And the problem is also that what we didn't discuss at all, Nasib, is that crypto, from a technical perspective, is developing so fast. If we start now to regulate something, it is only looking at the past until today. What happens in the next days, in the next month, in the next years, we cannot see coming. So it could be that we are setting up with MiCA 2.0 regulation, which is not flexible enough to allow the innovation still to foster and to develop. So regulation should never limit or cap innovation. If we want to be in Europe still in the forefront of innovation and technology compared to US and Asia, we must watch out that we do not over-regulate and that we never regulate innovation.
Stablecoins are filling gaps left by weak currencies and slow banks, but if they succeed too well, do they become a systemic threat to national monetary policy?
Yes, they become a systemic threat. They already become a systemic threat. But it's not because of the technology, it's because of the way how we regulate stablecoins in Europe. The best example I can give you is Circle. Circle has a European stablecoin, the EuroC, and they have a US dollar-based stablecoin, the USDC. If you look at the figures of Circle, you can see that the business outside of Europe, this is a major business. This is the major business. If you look at the total stablecoin market, Europe has less than 5% of the total stablecoin market. Yeah. So the strongest players are Tether, USDT, but Circle with the US dollar Circle. So what does it mean? If now the US is starting to allow, for example, European banks to issue a US dollar-based stablecoin, then German investors would start taking their euro and swapping their euro to US dollar, because you need to swap it to US dollar and pay the issuer of a US dollar stablecoin with US dollar. So we have a movement from euro to dollar. So the more US dollar backed stablecoins we see in the market, the more US dollar must be issued by the US Federal Exchange, and the more liquidity or the more euros will move to the US dollar. And that's a risk which also Mrs. Lagarde, Christine Lagarde saw, and already raised concerns by saying that European stablecoin issuers should not issue a stablecoin patched or backed by US dollar, which is not correct, because if you look at recital 54 of MiCA, it expressly allows multi-issuance. It expressly allows also to issue US dollar stablecoins. So the threat which I see is that if Genius Act is going to be as successful as everyone is believing, and the US is pulling all the stablecoin issuers to the US market, then the US dollar will become even more strong than it already is now.
And MiCA drew a line between e-money tokens and asset reference tokens, right? As you mentioned as well. So as real-world assets get tokenized and composable, is that distinction already outdated?
No, it's not outdated. It's not outdated. If we talk about real-world asset tokenization, we can talk about gold. If you tokenize gold, it's maybe an asset reference token. We could also talk about stocks, like Kraken acquired Backed Finance. We have the famous X stocks, and Kraken now just joint ventured with Deutsche Börse. So this is also a real-world asset tokenization. A real stock got tokenized. We could also look at money market funds. We have tokenized money market funds. So what I see in the market is that European or traditional stablecoins will be used in the next days, months, maybe in the next year, as a means to do automated T+0 atomic swaps. So you, for example, as a bank, as a big major bank, you can offer your customers, especially bigger companies, to change their fiat money to stablecoins. So they can take, let's say, 50 million euro and swap it to 50 million euro stablecoins from Circle or from AllUnity. And then your bank can tell the customer, listen, from the traditional fiat e-money, you're not getting interest. From a traditional stablecoin, you're also not allowed to get interest in Europe. But we can do through a smart contract, which we have, an atomic swap of your stablecoin against a money market fund, which gives you 8%. And a money market fund can be settled within 2 days, and we can even technically do a T+0, like an atomic swap, to get your stables back on your bank account immediately. And this is where I'm seeing now the business moving in changing the money to a simple stablecoin, but then using the stablecoin as a means of swapping to a yield-bearing instrument. This is exactly what in the DeFi industry is happening for the last 2 years. Now the traditional market is copying what the DeFi industry is doing.
Central banks and DAOs continue to frame CBDCs as safer than stablecoins. What is the real tension about?
I mean, safer, it's difficult to say. I think every digital money has its position in the market. I don't say that stablecoins are better than CBDCs, or CBDCs are better than, let's say, tokenized deposits like CBMTs, as we have seen with DZ Bank in Germany. Every token has its own business case. So as a CBDC, let's call it the digital euro, then we have to differentiate between retail CBDC and wholesale CBDC. The wholesale will be using a DLT. The retail will most likely not use DLT, but use a different technical infrastructure. It has maybe more safety measures because the issuer of the CBDC is the central bank. It's a European central bank. And the European central bank can never default. But this is if we talk about counterparty risk, this is already very interesting. Plus, by definition, then a digital euro has a status of money because it's issued by the central bank. Whilst a privately issued stablecoin is only e-money, not lender, not tender, sorry, not the traditional tender, not the traditional currency. But e-money, you can move very fast, you can issue very fast. This is probably a very good advantage. It is on a blockchain. It is maybe even on the EVM, and then you can do this atomic swaps that I just told you, against some other EVM-based instruments. Whilst the CBDC, I don't really know how that should work. I don't even know when it's coming out, the digital euro. So this is all very slow. And on the other hand, like a tokenized deposit, like from DZ Bank, this is also a very nice product because it's a deposit. So you have you fall with this instrument within this deposit protection scheme. So in Europe, every retail user has a deposit protection up to 100,000 euro, and this you only have with this kind of instrument. You don't have it with a cryptocurrency. A cryptocurrency does not fall within a deposit protection. So this is what I'm trying to tell you, Nasib. It really depends on the business case, what you want to do with the token, and each of these tokens have its own business case, for which the token is probably perfect.
I agree. How should the EU think about competitiveness in a world where the US might continue to have a lighter regulatory touch?
I think what we did wrong in Europe is that we did not work together with the OGs in the crypto market. If you look at the US is now working together with the Tether Foundation. We in Europe, we started forbidding everyone to use USDT or Tether-based coins because Tether does not have a license. We didn't even come to the idea of talking to Tether to try to find a common solution, to build something together. The US is showing us very easily how you can do it. It took them 1 month to invite the founders of the Tether Foundation to the White House. They happily joined the White House, and they're now working on the first stablecoin issued by a US bank, but technologically developed by the Tether Foundation. Why not using the advantage? Tether is in the market since 2014 with its stablecoin. We should not forget this. Why should we not use the advantage of such a traditional OG player and work with them together and not always try to think of how to regulate it, and if they're not complying with the regulation, then we are not talking to them. This is like the wrong move. And this is why I also said we should have more sandbox ideas, more sandbox models. And I believe that we missed the possibility to talk to the stablecoin issuers. Not that many people know that Tether is not from the US. The founders from Tether, they're basically from Lugano, they're from Switzerland, and originally they're from Italy. So we had the possibility to talk to these companies and to find a common solution. We did not do it. And there are some other major companies who also left to El Salvador, as Tether Foundation did. There are some other companies who left to El Salvador and do business either there or with the US government, and we missed this chance.
Do you think there is a geopolitical dimension to financial regulation in crypto, where jurisdictions are competing to host the next wave of infrastructure?
Definitely. This is definitely happening. I mean, if you look at the Middle East, I was just coming back from Dubai, and I was in a crypto conference there. I can tell you that Dubai, as an emirate within the United Arab Emirates, has moved so fast within the last 3 to 4 years on crypto that we must really watch out that we're not losing our advantage we have in Europe. The advantage we have in Europe that we are a very big market and that we are very traditional player when it comes to crypto, to traditional financial market. Maybe also to crypto when we look at Germany and so on. So Dubai is already pushing a lot. The Dubai regulator VARA is inviting the fintechs, is inviting the crypto players to do the business there. They have a zero tax environment. We have Abu Dhabi, another emirate within the United Arab Emirates. Abu Dhabi with their regulator ADGM, is doing also a very nice job. Yeah. So, and these are just two examples I gave you. But you can also look at other jurisdictions where they really are coming. Australia, in Asia, where we see Hong Kong and also Singapore putting up their own regulation. Of course, they do it to attract the players, as the US is doing with the Genius Act. The Genius Act is not limiting. The Genius Act is really a big sandbox model, which the US is putting there to attract the big players to go to the US. Yeah.
As more banks enter crypto custody and tokenization, where should the line be drawn between TradFi and DeFi?
That's very interesting. I think that the line we can only draw by looking what is left. So, for example, if a major traditional TradFi bank is providing custody, but only custody and let's say trading with the top 20 crypto assets, or only with stablecoins as a means of swap to tokenized money market funds, for me, this is still TradFi. This is not crypto. This is still TradFi because the remaining business of this major bank will be traditional banking. If, on the other hand, let's say 1inch would start providing more and more TradFi solutions, then the question is this crypto player becoming a TradFi player suddenly? And I think this is rather possible happening soon than a traditional bank becoming or losing its position as a TradFi company and becoming a DeFi or crypto company, yeah, suddenly. So yeah, and we really must look at the traditional crypto players who now go more direction TradFi, starting to offer tokenized security, starting to offer security token, because this is more and more then going to the TradFi solution. Yeah.
Should centralized institutions be allowed to issue stablecoins or permission DeFi products that mimic decentralization?
Yes, I mean, by law, they're not really allowed to do that. And what is also very important is the traditional banks, the traditional financial players, the people who work there, like from top down, C-levels, managers, department heads, they're all not familiar with crypto. So they will not really do some risky, complex crypto business. They will not do it. Yeah, they may be gonna go together like this consortium Kivalis in Netherlands. Now you see where you have, I think, 10 banks who get together and think of issuing a stable coin. But you will not see really that many banks now starting to do fancy, complex crypto business. This is not going to happen.
What's the right way to think about the balance between financial inclusion, user protection, and systemic risk?
That's a very good question. I mean, I think these are the points also which MiCA is trying to cover. I think the balance should be drawn there. We heard it a lot in the market. The so-called risk-based approach. If a crypto instrument or crypto service is posing a big threat, then we should regulate it. If it's not posing a big threat, then we should not do it. It was the same with NFTs. When NFTs were hyped, everyone was talking about NFT regulation. I'm very happy that MiCA, in the last draft, the last version of MiCA, excluded the NFTs. And they clearly said why. They said because the NFT market is not a big risk to the market because it is not big. It is not that big. And MiCA was the drafters, the lawmakers of MiCA, they were right. And there's also a very solid point. If the market is not that big, we should not really regulate it. If the market has a size where we say the risk is high, then we should also regulate it. So this is the risk-based approach. And until then, we should let the innovation foster and develop and let it be as it is. Yeah? And not look at small examples saying that out of 1 million person, one person got scammed. That's why we need to stop the market. This is not how it works. So we really need to look at at statistics, at figures, at KPIs, and then think on how to regulate it. And you see this already in MiCA a lot. In MiCA, at some chapters where the regulator was not clear if we need more regulation, the regulators clearly said we have to collect more information. For example, when there was the idea of limitation or to not allow proof of work blockchains like Bitcoin because of environmental ESG issues, mostly the Green parties suggested that. The others said, no, that is not needed. We actually must understand what is really the energy consumption. What is it really? Not just for the blockchain itself, for the token, for the service. And then we can say, okay, we need to regulate it. And this approach is better. First understand what is a risk, and then apply a risk-based approach.
Do you think Europe can realistically become the global leader in crypto regulation, or will it become the most bureaucratic?
And now I would say it's 50-50. We must loosen up also maybe with MiCA 2.0 before our very hard and tough position on stablecoins. And we must make clear to all the national competent authorities that they should not act outside the framework of MiCA, even though MiCA says whatever is not regulated by MiCA, national competent authorities are allowed to regulate or to do however they want to do. This we should limit. If we do not limit this, I see a big risk that we were going to have a over-regulation in Europe and a killing of the market.
What do you want to see in the final text of MiCA 2.0 that would signal Europe is serious about supporting innovation?
I would like to have more sandbox ideas inside MiCA 2.0. Not just regulation, but also sandbox approaches, maybe a whole chapter where we have some sandbox clauses where it says that if it's like this, if it's not white or black, it's grayish, then this grayish business should be a sandbox candidate. This would be perfect.
If you were advising a crypto founder in 2026, would you tell them to launch in the EU, the US, or somewhere else?
A very, very good question, very solid question. It really depends on your market. When I say on the market, it means your customers. Where are your customers located? If your customers are located in Europe, then get regulated in Europe. Otherwise, you're going to get in trouble. If your customers are outside of Europe, you should think, do you need partners or a market infrastructure like banks, payment service providers? We have them in Europe. Very strong, very strong. We don't have them in Dubai. We don't have them in Abu Dhabi. So if you need them, come to Europe. If you don't need market infrastructure, if you don't need European consumers, but you want to do the business and you want to do it fast, then don't choose Europe. Then you're going to lose time. Then go to Australia, Hong Kong, Singapore, Dubai, Abu Dhabi, maybe the US. This is then better for you.
What's one legal or regulatory blind spot that the entire crypto industry is underestimating right now?
Regulation of smart contracts, basically. So I give you one example. We always talk about crypto custodians, and we say a crypto custodian is the player or the actor who has the private key, who has influence on the token of the customers, who can freeze the transaction, or who can take the token and transfer it somewhere else, who really give a risk to the token. If you look at the stablecoin issuer, all stablecoin issuers have a smart contract and can, with the smart contract, freeze your token no matter in which wallet it is lying, because the token is still connected to the smart contract. But the stablecoin issuers, they're not crypto custodians. They usually do not have a license as a crypto custodian. And this is, I think, a big risk, which is totally underestimated, a total blind spot. And it happened already. We have seen it. OFAC was going to Tether Foundation, and telling to Tether, here's a list with wallets, please freeze these wallets, freeze the token. And Tether did it immediately. So if this happens to us, I was talking a couple of days ago to the German Ministry of Foreign Affairs. They used stablecoins to do transfer with Syria. They paid Syrian NGOs and Syrian human aid, and they used stablecoins. And I asked them, did you know that there's a risk that the issuer can freeze the transaction? They said, yes, we heard about it. said, yeah, that's a risk. And the regulator did not see it in Europe. And basically, we do not have anything against it. We do not have any rules, any license for that. So it can just happen. It can just happen that your assets, my assets, big assets in a wallet get frozen because we use stablecoins.
Where is the best place for listeners to find you and follow your work? That's a closing question.
So basically on LinkedIn, I'm quite active on LinkedIn. So if anyone wants to follow me, just go on LinkedIn and just connect with me, follow me. I'm regularly publishing there something or giving also hints, something is happening in the crypto market. Yeah, and that would be probably the best way. Or you see me at conferences and just stop by and have a coffee.
Yeah, I will include all the links in the descriptions. So, Alireza, thank you for bringing the regulatory clarity in the space badly needs, right? Looking forward to seeing how MiCA 2.0 takes shape and how it will define the rules of engagement for the next phase of crypto in Europe and beyond. And to everyone listening or watching, like, subscribe, or follow both of us, and share this episode with someone curious.